You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Merry Christmas, Bob.
Well, we are into that season, and a Merry Christmas to you and our listeners. We were looking at this week, getting prepared for December 21st, when we're really very certain that the days will start to get longer, if, the past is any guide.
I heard a rumor, or is it a myth? If you buy a stock on December 22nd, the odds are over 3 months it's going to go up.
I've never seen that one, but maybe we should give it a try.
It's happened 9 years in a row, apparently.
Oh, well, there we are. Okay, well, we got to look into that one. There may be some connection to the solar orbital mechanics, all that sort of stuff. But it's been an interesting few weeks here in the financial markets. You got the Eastern Europe, with the principal there being the neo-Soviet Union, as headed up by Putin. Their financial markets are in great disorder. The yield on their 10-year note soared way up to 16%. It's back to 13.5 now. On the same day, I think that was last Tuesday, just this Tuesday when it maxed out, that their ruble got smashed way down. It went from 30 earlier in the year up to 80 or something like that per U.S. dollar. Now, this is not good, and even though they raised short rates, I think it's market forces are raising them, and you read articles about Russians are buying cars real fast because next week they're going to be higher priced, so they're into pretty good currency depreciation and inflation, but it's not healthy. It's just not good at all to go through that. And then countries that are joining Russia, of course, Ukraine has been in even more severe straits, so financially in their credit markets. So it's not good. One thing that's missing is important central bankers in the Western world getting out and saying, well, the Russia's problem is isolated. Well, we haven't seen that. They usually do it when, some lesser market develops a crisis, and then they all get in the bandwagon and say, well, it can be isolated, it can be contained. They may have seen it, but we haven't seen it here yet, so hopefully it comes out. And on the other hand, the long bond, long-dated U.S. Treasuries have been acting particularly well. They got up to, I think it was 147 and change in the middle of October, when there was that then crisis all the way around the world. Let's just call it a mini crisis. And at the opening in New York that day, there was no offers on the long bonds, and the bond futures spiked up 5 points in no time at all. That set the high at almost 148, and then of course it corrected back. But it was an instruction, because at an instant, the most liquid 10-year bond in the world lost liquidity. So here we are. Then the bonds backed off quite a bit, and in the last month they've had a terrific rally, and our target has been to go back up and test that 148 high. Well, it's gone past it, but it's now getting overbought. It looks like it's an ending action in this, because the rally on the long bond has been outstanding. This has been against the junk bonds, for example. They had a momentum peak in June, and sort of quietly crept down, and little rally into September, but not as high as they were in June. And then after September, they just tanked, went straight down, and that, of course, was that a number of issues in the J&K bond index were, I think about 17% of junk bonds were oil patch bonds here in North America. So as crude went down, so did the junk bond prices. So it got down on Tuesday to being, it had a downside capitulation on J&K. So we put out a quick memo saying cover shorts in crude oil and in junk bonds, and both have sort of bounced up a little since. On the crude oil, we had our three-legged fundamentals on that going back to the summer, where you can get a seasonal decline in crude oil from September down until December. You had the example of back in 1985 when Reagan wanted to have the price of crude down, and he had a side deal going with Saudis not to support a natural decline in crude's price. And then the former Soviet Union ran out of the hard stuff, money, and it helped collapse them. And this time I've been saying would be a very good exercise to have something similar happen to unfund Putin and his statist ambitions, and also deny funding or reduce funding to the crazies in the Middle East. And this is happening. Crude oil fell from 107 in June or July right down here to, in the 50s. And it's popping up here a bit now at 56. So now we've found also the other part of our bearishness on crude in the summer was that with the fracking, natural gas dropped down from to a much lower price trading range due to ample supply. Then we figured that the same thing would happen as reserves of tight shales for crude oil increased, and indeed it would be something that we thought would be in the long term, but it's happening. And then what we're looking at here is that when you have a crash in crude oil, we looked back at about 3 of them, I guess, and they last typically 6 to 7 months, which then counts out to either December or January, at a time when you would look for an important bottom in the price of crude. It's already given, it's already way oversold and all that sort of thing, but it's been an extraordinary condition. So our view is that you're not going to get one single V bottom out of this and then going on to happy prosperity in the oil patch. It's going to take, and after looking at previous post crashes in crude, it's going to take a few months to set a bottom. So let's keep that one in mind. Also in June, July, the oil patch stocks, the ETF is XLE, got way overbought, and now we're looking for it to get oversold. But again, I think this is going to be a market for traders, not for investors looking for the longer go. And this, of course, is added to the bear market already going on in base metals. You've had them slip down to new lows. Their highs were, these things all had base metals, and the CRB all had their high, big important high in 2011. Our technical indicators were going tilt on all of those things in 2011, and we thought there'd be a cyclical bear market. Well, the CRB and the ETF for base metals have made new lows this week. So, who wants to rush in other than traders? On our ones, the ones we've liked for the last number of months, and it had the best technicals, which was the grains. That's the ETF is GKX, and it set its low there a few months ago, and in nice little corrections on the way up has moved up. But the latest 3 weeks on it, the rally's been steepening, and it is becoming a little overbought. So the view on the grains has been positive, but now this thing could go into a consolidation phase, kind of work on more of a correction than it's had so far. Then you look at others, the hot ones earlier in the year, when we did the one on butter, was going straight up, put all kinds of technical signals, and it's been coming down. And then a month or so ago it was feeder cattle, and they're now correcting. And not many of our subscribers are out-and-out commodity traders, but we put out these charts when they jump out at you in order to show that there are items, like some commodities, that trade without interference, and they go up and they set very overbought signals, and then they go down. Whereas in the stock market, for example, the big New York market, it goes up and achieves, cyclically excessive readings in sentiment and momentum, which it's been doing since July, and then you get corrections in here. But it's there's a big bid in there, government bid, who knows, and then you're getting the heads of the central banks in Japan, in Europe, and in the United States coming out with timed announcements crafted to turn the juices on in the bulls in the stock market. So I've never seen a time when the central bankers were actually straight out promoting the stock market. So it'll be interesting to see how it goes. They got a little oversold here with this thing. So with some stability in crude oil for a while, the financial markets should stabilize. But what we're looking at here is that often on long treasuries, you can get a seasonal rally up into year end. And this is what we think will be the ending action on the long bond contract. And then probably in the new year, junk bonds will start heading down again. I mean, they've had quite a decline, and I think that a large part of the bond buying community might be getting a bit wary of them. The risk is coming back into the equation.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Bob, what do you think is going to be the hot investment or the hot direction in the new year?
I think after some stability, the big, we can call it a rotation. Last year, our rotation out of Christmas was that some of the beat-up commodities, base metal stocks, the crude oil sector, and the gold and whatnot, coming generally out of Christmas. Well, base metals waited to February before they rallied. But nonetheless, we thought the move would be from lows around Christmas out to highs somewhere in the spring. Not each sector did not complete at the same time. There were highs. But anyways, come late spring, early summer, they had all peaked. So now we looked at this time, and on these sectors, we're not getting it, other than the base metals going up. So then, but you've had a severe bear market for the precious metal sector. And earlier in the year, we thought maybe they might have a low and you could begin to accumulate them in late October. And when we got into late October, they were still falling and they fell hard into November, December. And a couple of weeks ago, we suggested that on the next dip, one would accumulate a little, just begin to buy some. And we're content with that just to start. But what we need in this is that once you get past an important bottom for the precious metals, particularly gold, I think the gold sector would be one of the big winners next year. Losers, I don't know yet. Let's put it this way. The gold sector would likely be the best sector. And by our next broadcast, we'll figure out what maybe opportunities there are in the orthodox market. But the stock market with the S&P and whatnot, they've had some shakes. But you've got the lead in Europe where their stock market, STOX, is really not acting well. Europe has gone insane on energy policies where they have been shutting down old, very efficient plants, either coal or nuclear, and putting in the faddish windmills and solar panels, and that is very expensive energy costs. So they're committing economic suicide over there. So I don't see much to really turn their stock market around. In recent technicals, it's looking weak. So this and also the next leg down in lower grade bonds is not going to be too healthy. So we think that it's setting up the precious metal sector to be about the best sector out there.
Bob, have a great Christmas, and I hope you and your family have all the best in the new year as well.
And all the best to you and yours too, and our listeners. A good Christmas, a Merry Christmas, and a Happy New Year. And we'll leave her at that.
My guest has been market historian Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. His website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@ HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.